Welcome back to Report of Silver. If you follow gold and silver markets closely, then today's discussion is one you cannot afford to miss. Because right now, both metals are trapped in a battle between two powerful forces. And until one side wins, gold and silver may continue moving sideways in what many investors are calling one of the most frustrating trading environments of the year. On one side, we have rising bond yields and growing expectations that the Federal Reserve may be forced to stay aggressive or even raise rates again. On the other side, we have rising bond market stress, persistent geopolitical uncertainty, and continued long-term demand for hard assets. These two opposing forces are creating a wall, and that wall is keeping gold and silver trapped in a range. The big question now is simple. What breaks first? Do precious metals finally break higher, or do they experience a deeper correction before the next major move begins?
That is exactly what we are going to explore today. Before we begin, I want to hear from you. Do you believe silver breaks above $80 soon, or do you think we revisit lower levels first? Put your thoughts in the comments because your perspective always adds value to this conversation. And if you appreciate honest analysis on gold and silver without the noise, make sure you subscribe to Report of Silver so you never miss an update. Let's begin with what happened today. Gold and silver were under pressure once again. Both metals traded lower, although the damage was much less severe than what we saw in the platinum group metals. In fact, for precious metals investors, this was another reminder that Fridays often bring volatility and what many stackers call the Friday smackdown. It has almost become routine in this market. Yet despite today's weakness, there is something important to understand here. Neither gold nor silver broke down in any meaningful way. They simply remain trapped in the same range they have been stuck in recently. Silver is the perfect example. Earlier in the session, silver briefly pushed above $80 an ounce, which immediately got traders excited. For a moment, it looked like the breakout everyone had been waiting for was finally underway. But then, just as quickly, sellers stepped in and pushed it sharply back down. By the end of the day, silver was right back near the middle of its range, hovering around $75. That tells us something very important. The market wants direction, but it cannot find conviction. Gold is showing the same pattern. It continues to hover around the $4,500 level, unable to break significantly higher, but also refusing to collapse. This is classic range-bound behavior. To some investors, it looks boring. To analysts, it looks like pressure building, and that pressure is being created by two competing market drivers. The first driver is rising bond yields. This has been one of the biggest headwinds for precious metals. The 30-year U.S. Treasury yield remains above 5%, which is a very important psychological and financial level. At the same time, the 10-year Treasury yield is still holding above 4.5%. Those are elevated levels, and they matter because when yields rise, bonds become more attractive to investors looking for income. Gold and silver, by contrast, do not pay interest. They are non-yielding assets. That means higher bond yields increase the opportunity cost of holding metals. This is why traders immediately become nervous whenever yields move higher. The logic is straightforward. If investors can earn more from bonds, some money may leave precious metals and move into fixed income. That creates downward pressure on gold and silver prices. And this is where the Federal Reserve enters the picture. Markets are increasingly pricing in the possibility that rates may stay higher for longer. Some investors are even beginning to discuss the possibility of another rate hike later this year. Just a month ago, that seemed unlikely. Today, it is part of the conversation again. That change in expectations is enough to make precious metals investors uncomfortable, but this is only one side of the story. The second driver pushing against that bearish pressure is bond market stress itself. And this is where things get fascinating. Rising yields are not always bad for gold. Sometimes rising yields signal economic strength and higher rates, which hurts gold, but sometimes rising yields signal fear, instability, and distrust in government debt. When that happens, gold and silver often benefit because investors begin searching for alternative stores of value. That is the tension we are watching right now. Are yields rising because the economy is strong and inflation remains sticky, or are yields rising because confidence in sovereign debt is weakening? Those are two very different stories, and the answer matters enormously for precious metals. Some analysts believe we are getting closer to the second scenario. They argue that if yields continue rising in a disorderly way, investors may stop seeing bonds as safe havens and start viewing gold and silver as the safer alternative. That would be a major shift in market psychology, and if it happens, it could trigger the next major rally in precious metals. But we are not there yet. That is why gold and silver are stuck. They are trapped between these two forces, higher rates pushing them down and bond market stress supporting them from below. Neither side has won, and until one side gains control, we may continue to see this frustrating sideways movement. For stackers and long-term investors, this kind of market can actually be useful. Sideways markets allow disciplined investors to dollar cost average. They create opportunities to slowly build positions without the emotional pressure of chasing vertical price spikes. It may feel boring, but boring can be productive. On the other side, rising bond market stress and growing distrust in sovereign debt are creating a powerful underlying support floor. That is why these metals feel stuck. But now we need to go deeper, because the real story is not just that yields are rising. The real story is why they are rising, and that distinction could determine where gold and silver go next. This is where many casual investors get confused. They hear that Treasury yields are moving higher and immediately assume that is automatically bearish for gold and silver. Historically, that has often been true. When bond yields rise because the economy is growing, inflation is manageable, and the central bank is tightening policy, investors often rotate money out of non-yielding assets like gold and silver and into bonds. That is the classic textbook reaction. But markets do not always behave according to textbooks. Sometimes yields rise for a much more dangerous reason. Sometimes they rise because investors begin demanding higher returns to compensate for increasing risk. That means they are becoming less confident in government debt itself. That is not a normal economic signal. That is a warning sign. And when that happens, gold and silver often begin to act very differently. This is exactly what some analysts are watching right now. Naheem Alam, chief investment officer at Zay Capital Markets, recently pointed out that the risk of a bond crisis is rising even if the full storm has not yet arrived. That statement matters because it captures where we are today. We are not in a bond crisis, but we may be moving toward one. That distinction is important. What would that look like? It would mean long-term yields, especially the 10-year and 30-year Treasury yields, begin rising in a disorderly way. In other words, yields would no longer move because of normal inflation expectations or routine Federal Reserve policy adjustments. Instead, they would move because investors are beginning to question whether U.S. government debt still provides the same safe haven protection it once did. That is a major psychological shift. For decades, U.S. Treasuries have been considered one of the safest assets in the world. They have been the backbone of global finance. Pension funds buy them, central banks hold them, institutions trust them. But if confidence in that market begins to weaken, even slightly, investors start looking elsewhere for safety. And that is when gold and silver become extremely attractive. This is why Alam said investors need to watch one very simple signal. If long-term bond yields continue rising, but gold stops falling, that would tell us something profound. It would mean the market is no longer treating higher yields as a reason to avoid precious metals. Instead, investors would be buying metals because they see deeper financial stress emerging. That is the moment everything changes. And honestly, we may be closer to that moment than many realize. Think about what has already happened this year. Treasury yields have climbed sharply. Inflation remains stubborn. Rate cut expectations have collapsed. The market has gone from talking about multiple rate cuts to openly discussing the possibility of rate hikes again. That is not a small shift. That is a dramatic repricing of monetary policy expectations. At the same time, investor confidence is becoming more fragile. Consumer sentiment is weak. Inflation expectations remain elevated. Global geopolitical tensions remain unresolved. Debt levels continue rising, and governments everywhere are spending aggressively. Those are not conditions that inspire calm. Now add in the Middle East. The Iran conflict continues to hang over markets like a storm cloud. Oil prices remain elevated, even though they ease slightly today. Crude is still trading near $96 per barrel, which is historically a very high level. Elevated oil prices feed directly into inflation. They raise transportation costs, manufacturing costs, and consumer prices. That keeps inflation sticky and forces central banks into difficult decisions. This creates another trap. If the Federal Reserve stays hawkish to fight inflation, that pressures gold and silver in the short term. But if aggressive policy causes financial stress or breaks something in the bond market, then gold and silver become safe havens again. That is the paradox. It is why metals are not collapsing, even though yields are elevated. There is too much uncertainty underneath the surface, too much unresolved risk, too much fear hiding beneath the headlines. And this is why long-term investors should not confuse short-term frustration with weakness. A market that refuses to fall despite repeated pressure is often telling you something important. It is showing resilience. Silver's refusal to stay below the mid-70s and gold's refusal to break down from the $4,500 region are examples of that resilience. The market is absorbing bad news and not breaking. That matters, because when markets stop reacting negatively to bearish news, it often means sellers are losing power. That does not guarantee an immediate rally. It does not mean next week we suddenly explode higher, but it does suggest underlying strength that should not be ignored. This is why many experienced stackers stay calm during periods like this. They understand that sideways markets often hide major transitions. The breakout usually comes after boredom, not excitement. And right now, precious metals feel boring, but boring can become explosive very quickly. Another major reason gold and silver refuse to break down is something that many retail investors underestimate, and that is the role of central banks and sovereign reserve management. While short-term traders focus on bond yields, inflation data, and Federal Reserve speeches, large institutions and governments are quietly making much longer-term decisions. Those decisions do not happen day to day. They happen over months and years, and increasingly, those decisions are supporting precious metals. This is one of the strongest floors under this market right now. For decades, central banks around the world relied heavily on sovereign bonds, especially U.S. Treasuries, as the core of their reserve strategy. It made sense. Treasuries were liquid, stable, and widely trusted. But over the last several years, something has changed. That trust has started to weaken. Not collapse, but weaken. And when trust weakens, reserve managers begin diversifying. That diversification is increasingly flowing toward gold. We have seen this trend accelerate globally. Central banks have been purchasing gold at record levels. This is not speculation. This is policy. Countries like China, India, Poland, and many others have been steadily increasing their gold holdings. They are not doing this because they expect next week's price to go up by 2%. They are doing this because they are thinking about monetary security 10 years from now. That is a very different mindset. And that long-term mindset matters because it creates persistent demand beneath the market. It acts like a cushion. Every time prices fall sharply, there is often quiet institutional buying underneath that absorbs part of the selling pressure. That is why major corrections in gold have become more difficult. Now, silver does not benefit directly from central bank buying the way gold does, but it benefits indirectly. Why? Because silver historically follows gold, especially during major monetary transitions. When confidence in fiat systems weakens, gold usually moves first because it is the primary monetary metal. Then silver often follows, and many times silver moves more aggressively because its market is much smaller. That is why long-term silver investors pay very close attention to central bank gold accumulation. It is not just about gold. It is about what gold is signaling. And what gold is signaling right now is that governments themselves are becoming more defensive. That should matter to every investor. Another factor adding support is the quiet rollover from sovereign bonds into precious metals. Some analysts describe this as one of the least discussed but most important trends in global finance. Instead of publicly announcing a major strategic shift, institutions simply reduce bond exposure slowly and add more hard assets over time. It does not create headlines, it creates trends. And those trends can last for years. This helps explain why some analysts believe there is now a hard floor under gold. One market strategist recently argued that while gold could see a short-term correction, even potentially down toward $4,000, the odds of a major collapse remain low because sovereign demand remains too strong. That is important. Could gold pull back? Absolutely. Could silver retest lower support? Certainly. But could they completely fall apart while central banks continue accumulating? That becomes much harder to argue. This is why many long-term precious metals investors are surprisingly calm right now, even as prices chop sideways. They understand that beneath all the daily volatility, there is a structural demand story unfolding. Now let's add another layer. The US dollar has also begun showing signs of weakening momentum. That matters because gold and silver often perform well when confidence in the dollar fades. It does not mean the dollar is collapsing. It simply means the unquestioned dominance of the dollar is being challenged more openly than before. We see this in global trade discussions. We see it in bilateral settlements outside the dollar system. We see it in conversations around alternative reserve assets. And again, when governments start asking these questions, gold naturally benefits. Silver benefits too, because silver is both a monetary metal and an industrial metal. That gives it dual demand potential. If monetary demand rises while industrial demand remains healthy, silver becomes especially interesting. And that is part of what makes silver so frustrating and so exciting. It can sit still for long periods, then move violently. Many investors forget that. They see weeks of sideways trading and assume nothing is happening. But underneath the surface, foundations are being built. That may be what we are seeing right now. Yes, silver has been boring near $75. Yes, gold has been hovering near $4,500. But boring markets often build the strongest bases. They wear out impatient traders. They test conviction. They force weak hands out. Then, when the next move comes, it often surprises everyone. That is why patience matters. And there is another reason patience may be rewarded: market psychology. Right now, many investors are confused. Some expect rate hikes. Others expect recession. Some expect a bond crisis. Others expect economic resilience. That uncertainty creates hesitation. Hesitation creates range-bound trading. But eventually, one narrative wins. And when it does, gold and silver will stop moving sideways. They will choose a direction. Even with all of this long-term support beneath the precious metals market, investors still need to respect the short-term risks, because markets rarely move in a straight line. This is one of the biggest mistakes emotional investors make. They become so convinced in the long-term bullish story that they stop paying attention to short-term volatility. That can be dangerous, especially in gold and silver, because both metals have a long history of making dramatic moves in both directions before continuing their larger trend. And right now, that short-term risk is very real. Some analysts are openly warning that gold could temporarily drop toward $4,000 an ounce before making its next major move higher. For some viewers, that may sound shocking. After all, gold has been showing tremendous resilience. It has survived aggressive rate expectations, elevated treasury yields, geopolitical uncertainty, and still remains near historically elevated levels. So why would anyone think a correction of that size is possible? The answer is simple. Markets need to reset. When an asset moves higher as quickly as gold has over the last year, it often becomes overextended. That does not mean the bull market is over. It simply means the market may need time to digest gains. Sometimes that digestion happens sideways. Sometimes it happens through a pullback. Both are normal. And if gold were to fall toward $4,000, silver would almost certainly feel that pressure. That is where silver investors need to remain realistic. Silver is more volatile than gold. It always has been. That is part of its personality. When gold rises, silver often rises faster. But when gold falls, silver can fall harder. That is why silver can be emotionally difficult to own. It rewards patience, but it also tests patience. We saw that recently when silver briefly moved above $80, only to get pushed sharply back down towards $75. That is not weakness. That is volatility. That is silver behaving exactly the way silver has behaved for decades, and that volatility can continue. Another short-term headwind is the possibility that the Federal Reserve stays more hawkish than markets want. Right now, the CME FedWatch tool is showing a growing probability of a rate hike before the end of the year. That is a dramatic change from only a month ago when most investors were still talking about cuts. Think about how quickly sentiment has changed. A few weeks ago, markets were discussing easing. Now they are discussing tightening. That matters because markets hate uncertainty. And right now, monetary policy expectations remain extremely uncertain. If inflation stays sticky, especially because of elevated energy prices and ongoing geopolitical disruptions, the Fed may feel forced to maintain a tough tone. Even if they do not actually raise rates, simply talking aggressively can pressure metals in the short term. That is what many traders are watching. At the same time, economic data remains mixed. Consumer confidence has weakened sharply. Inflation expectations remain elevated. Growth is slowing in some areas but not collapsing. Labor markets remain relatively firm. That creates a very confusing macro environment. And confusion tends to create hesitation. Hesitation creates sideways markets. That is exactly what we are seeing in gold and silver. Another near-term risk is reduced momentum from central bank buying. While long-term sovereign demand remains strong, some analysts believe the pace of central bank accumulation could slow temporarily. Even a slowdown, not a stop, just a slowdown, can affect investor sentiment. Markets are emotional. They react not only to what is happening, but to the speed at which it is happening. If investors begin to believe central banks are buying less aggressively, some short-term optimism could fade. Then there is the issue of profit-taking. Never underestimate this. After major rallies, institutional traders often lock in profits. It is not personal. It is not bearish. It is simply portfolio management. That kind of selling can create short-term downward pressure even in healthy bull markets. That is why corrections should never automatically be interpreted as the end of the story. Sometimes a pullback is simply preparation for the next move higher. And honestly, many experienced stackers welcome pullbacks. Why? Because they allow disciplined accumulation. A lower silver price is not necessarily bad news for someone still building a position. A lower gold price is not necessarily bad news for someone focused on long-term wealth preservation. It depends entirely on your time horizon. Short-term traders may fear volatility. Long-term holders often embrace it. That difference in mindset is crucial. This is why I continue saying that patience matters more than prediction in markets like this. Nobody knows whether gold touches $4,000 first or breaks to $5,000 first. Nobody knows whether silver revisits the low 70s or breaks above $80 next week. But what we do know is this: the long-term structural case remains intact, even if the short-term path remains messy. That distinction helps investors stay emotionally grounded, because emotional mistakes usually happen during sideways periods like this. People get bored, they lose conviction, they sell too early, then the breakout happens without them. That is the danger. So what should gold and silver investors actually do while the market remains trapped between these two powerful forces? That is really the most important question, because at the end of the day, understanding the market is only useful if it helps you make better decisions. Right now, gold and silver are not in a clear breakout phase, and they are not in a major collapse either. They are in what I would call a decision zone. The market is waiting. Investors are waiting. Even institutions appear to be waiting. And while that can feel frustrating, especially for those who want immediate action, this is often where the most important long-term opportunities are created. Sideways markets test patience, but they also reward discipline. That is the first thing to understand. For long-term precious metals investors, this may actually be one of the healthiest phases we could ask for. After strong upward moves, markets need time to breathe. They need time to digest gains, shake out weak hands, and build stronger support levels. That process is rarely exciting. In fact, it often feels boring. Silver hovering around $75 and gold staying near $4,500 may not generate dramatic headlines every day, but it tells us something important. It tells us the market is absorbing pressure and refusing to break. That is not weakness. That is resilience. And resilient markets often surprise people to the upside when the next major move begins. That does not mean investors should ignore risk. Quite the opposite. This is the perfect environment for smart risk management. If you are actively buying, dollar cost averaging makes a great deal of sense here. Instead of trying to perfectly time the next move, investors can slowly build positions over time. If prices dip lower, you buy some more. If prices move higher, your existing holdings benefit. This removes emotional decision making. And in volatile markets like silver especially, reducing emotion is one of the most valuable strategies available. At the same time, this is not a market for panic. Too many investors watch daily price moves and allow short-term red candles to control their emotions. Silver drops 2% and suddenly they feel fear. Gold moves sideways for 2 weeks and suddenly they feel doubt. That mindset usually leads to bad decisions. The strongest investors understand that short-term price action is often just noise inside a much larger trend. If your goal is wealth preservation, monetary insurance, or long-term accumulation, then these day-to-day fluctuations should not shake your conviction. Now, if you are a trader, the strategy is different. Traders must respect the range. Right now, silver appears trapped roughly between support in the low to mid-70s and resistance near $80. Gold appears trapped around that $4,500 zone. Until those levels break decisively, chasing emotional moves inside that range can be dangerous. This is where discipline matters. Let the market show its hand first. Don't force a trade because you are impatient. Markets punish impatience. And what are the key signals we should watch from here? First, continue watching Treasury yields, especially the 10-year and 30-year. If yields rise but gold refuses to fall, that is an important sign that investor psychology may be shifting. Second, watch the Federal Reserve narrative. Any softening in their tone could immediately support precious metals. Third, monitor geopolitical developments, especially in the Middle East, because energy prices remain one of the fastest pathways to renewed inflation pressure. And finally, keep watching central bank activity, because sovereign buying remains one of the strongest structural supports beneath this market. My personal view is simple. Gold and silver may remain frustrating in the short term, but the long-term story remains very compelling. Rising debt, sticky inflation, global reserve diversification, central bank accumulation, and ongoing geopolitical instability all continue to support the case for precious metals. None of those drivers have disappeared. In fact, most of them are becoming stronger. That is why I believe this current range is not something to fear. It is something to respect. It may last longer than people want. It may test patience more than people expect. But eventually, this wall that gold and silver are trapped behind will break. One of these competing forces will win. Either higher rates finally push metals lower for a deeper correction, or bond stress and global uncertainty ignite the next leg upward. Either way, a major move is coming. Markets do not stay trapped forever. For now, patience remains the strategy, discipline remains the advantage, and conviction remains the difference between investors who benefit from the next move and those who miss it entirely. Let me know what you think in the comments below. Do you believe gold and silver break higher from here, or do you expect one more correction before the next rally begins? I always enjoy hearing your perspective. And if you found this analysis valuable, please support Report of Silver by liking, sharing, commenting, and subscribing. Thank you for spending your time with me today, and as always, keep stacking, stay informed, and hold tightly to your precious metals.